Good day, everyone. Once again, welcome to our Insights show. We have a very special guest. I keep saying we have a very special guest, but this time around, he's really special. He's Raj Mehta from the famed fund house PPFAS. Raj, thanks for joining on a busy day like today when the election results are out.
Thank you so much for having me here.
Great. Raj, as usual, we have read your profile. You are a career veteran at PPFAS. You started, as an analyst. Now you're a fund manager. So tell us about your, journey. How you got interested into finance, and how you ended up in PPFAS, and your journey so far in brief.
Sure. So, my dad is a chartered accountant. So, from my school days, I wanted to become a chartered accountant first. So, after my chartered accountancy days, I thought that stock markets was something which interested me because during my articleship, I used to invest my stipend into equity markets, though it was very low, but still that was a good starting point to have. And since then I thought that I wanted to enter into equity research field where every day is a new day for the analyst, where something or the other is happening around the world and that impacts the stock prices. So that's where I started off. Uh, so when I decided that I wanted to enter into equity research, I looked for other courses which I could enroll into so that I could get knowledge into the research part. So then I enrolled for CFA, and after completing two levels, I thought I have a good financial base with a CA degree plus two levels of CFA. So that's when I was looking for job. 2012 was a very tough year in terms of getting new jobs. So then I approached PPFAS and Mr. Rajiv Thakkar, who is the CIO currently. At that time also he was the CIO. So then when I initially approached, he said that there are no vacancies right now. So then I thought that let's start off as an intern without any stipend as such, without any salary, and then as and when I learn the tricks of the trade, and then I can move on to other roles as and when possible. So I started off as an intern here. After about 10 to 11 months, we started our mutual fund here. Before that we were a PMS. So when we started off as a mutual fund, I was recruited here itself as an analyst, and then from analyst role I moved on to the fund management role sometime in 2016. So that's how the career progression has been. I have always been curious to know why stock prices move, and that's what got me here.
Interesting journey, from an analyst to a fund manager. Exciting to hear that, Raj. Now, PPFAS needs no introduction, but there are still listeners that we have who probably have not come across the fund. So, give us a little bit history. What does PPFAS stand for? Who was Mr. Parikh, and what is it that you guys are doing unique? And you also mentioned that you were a PMS fund. I think, if I'm not wrong, I think you're one of the first PMS funds that converted itself into a mutual fund house, right? So, give us a brief history of your founder and what your fund is and what you stand out for.
Sure. So for those who don't know, PPFA stands for Parag Parikh Financial Advisory Services. So it's named after our founder, Mr. Parag Parikh. He was a very well-known value investor, and he was the one who actually started equity research in India sometime in early 90s, when foreign investors were allowed to invest in India. So that's when uh, so just to give you a background of our firm, it started off sometime in 1979, and we started off as a stockbroking firm. Since then, we moved on to becoming a portfolio management services or a PMS firm. So we were the first ones to get a PMS license in 95, 96. And since then, we have moved on to the mutual fund business sometime in 2013. So the reasons for moving from a PMS business to mutual fund business was that we wanted to serve retail investors. Also, the limit or the minimum investment limit which SEBI had was increased from 25 lakhs to 50 lakhs. 5 lakhs to 25 lakhs at that point in time. And then we thought that taxation wise also for retail investors, mutual fund was a much more efficient structure compared to a PMS. So that's when we started our steps towards launching our own mutual fund. Another thing which prompted us to launch a mutual fund was that post the global financial crisis, we thought the stocks in US were really attractive, and to invest in them under the PMS structure was not possible. So we used to advise clients on where to invest in foreign markets, but we couldn't do it ourselves under the PMS structure. So under the mutual fund structure, we built our product in such a way that we could invest in both Indian as well as foreign stocks together. And that's how our flagship scheme, which is the Parag Parikh long-term equity scheme, which is now called the Parag Parikh Flexicap Fund. That's how it came into being. So basically how this fund is structured is that 65% is invested in Indian equities and the balance is invested in foreign securities. Uh, we wanted this to be a fund where it can do everything. We can stay in cash if we want to. We can invest in foreign equities. If we find that foreign equities are expensive, we can be 100% in Indian equities also. So basically, it was a Swiss Army knife, which we called it. It could do anything that the investor wanted. And the basic aim of the fund was to earn reasonable returns. And that has been the aim that we have had since the PMS days. So we don't want to tag ourselves to a benchmark. We want to earn absolute returns which are reasonable for the investor. So that's how we started off. After the initial fund, we came out with three other funds. Parag Parikh Liquid Fund was the second fund which we launched, and that was at the behest of our investors who wanted to invest in the liquid fund and then do STPs or switches into the flagship scheme. So that was one. The other scheme which we launched was the tax saver or the ELSS fund. So again, this was at the behest of our distribution partners and the end investors. So they wanted a product which would give them benefits under ATC and a pure equity fund as well, Indian equity fund as well. So that's when we launched our Parag Parikh Tax Saver Fund in 2019. And last year, we launched our conservative hybrid fund, which we like to call a debt fund from our fund house, which basically just like a flexicap, which can do anything on the equity side, this can do anything on the debt side. So we don't want to take any major credit risk, but we are willing to take interest rate risk as long as the end investor is willing to wait it out for the longer term. So that's how our fund structure is currently.
Great. So let's talk more about your flagship fund here. As you rightly said, now the name or the scheme has been changed to Flexi Cap, right? Thanks to the SEBI regulation that came in last year. And now again, one more regulation that came in recently, where you're now restricted to take any new, other than SIPs, I believe, any new fresh funding into that, because there's a cap on foreign remittance. How has that impacted you? Last 2 years, if you see, there's a lot of scheme level changes has happened. You still have invested, continuing to invest in US and other outside funds, but now with this restriction posed by SEBI, do you see it changing anytime soon, or how have you adapted to this new situation?
So what has happened is that there is an industry limit which has been set by RBI to invest overseas. So this limit was set sometime in 2008, and the industry limit is $7 billion. SEBI has set a per AMC or a per fund house limit of $1 billion within the $7 billion limit. So what happened was that in the last couple of years, we have seen the foreign markets doing really well, and most of the fund houses have come out with NFOs of funds which invest overseas. So this limit got exhausted very quickly, and sometime in January end, AMFI and SEBI realized that we are very close to hitting that limit. So then they suggested to stop remitting any more dollars from 2nd of February onwards. And that's when we stopped inflows into our FlexiCap scheme. So The existing SIPs and STPs would continue, but any new SIP, STP registration as well as lump sum investments were restricted. So as of now, what is happening is that whatever SIP, STP inflows that we received during the month are invested in only in Indian securities because we are restricted from investing abroad. Going forward, we don't know how long will it take for the RBI to increase the limit, but we are hopeful that they will increase the limit soon. They have taken a little longer than what we had expected, but we don't know the timing or the limit that they will increase. So whether they will increase it by 2 billion, 4 billion, 6 billion, we don't know the limit also. So we'll wait and watch till then. As and when we feel that it's taking very long, we may start inflows into the Flexicap and invest only in India as well. So that's an option we already have, but let's see, we'll wait and watch how it goes.
Okay, related to this, I had told the community that we have at Alpha Street and other social media that I'm going to interview you. So related to this, there's a question that a community member asked. So his concern is with the restrictions in growing your AUM and immediate restriction, right? You are known for your value picks, right? Value investing picks. You are known for that. Would you be forced to compromise on your stock picks now with all these restrictions? So any thoughts on that? In other words, are they going to abandon their value investing principles? So any thoughts?
The philosophy, the approach remains the same, irrespective of the situation that we are in. So we are not willing to bend our morals or bend our principles to any extent. We'll put our investment approach, and that will remain the same always, not today, next year, year after that, but always it will remain the same. So the inflows which have been restricted do not impact us in any way, because whatever SIP inflows we are receiving, we are finding opportunities in India, so that's not a problem. On the other side, I would also like to say that the valuations in foreign markets have become even more attractive. So if the RBI and SEBI increase the limit, we will be very happy to take the inflows and invest abroad also. So yeah.
Good to know. Good to reassure your investors that you'll stick to your principles. Excellent. Another question that came in, I think it's got to do with recent performance of Facebook, right? You have a significant stake in Facebook. Why is Facebook still part of Flexicap portfolio? What's the reasoning behind investing in Facebook? Another question from investor.
So Facebook, as we all know, is a very, very big player in the digital advertising market. And at the same time, they have some other platforms which have not been monetized fully. So something like WhatsApp hasn't been monetized fully. Instagram is something which they have been expanding very rapidly. And the reason for the fall in the recent times is because of the major investments they have done on the metaverse side. So whether that will work or not is a question mark. We don't have an opinion either way. We'll also wait and watch. But the investors are worried about the major investments that they have done in the last year or so on the metaverse side. So if that works out well, it's very good. If that doesn't work out well, then we'll see how it goes. So these kind of investments have been made by other companies like Alphabet and Amazon also, and some of them work, some of them don't work. So you need to use the cash flows of the cash cow that you have very judiciously. So that is what we'll be looking for.
Great. Shifting gears a little bit to your latest hybrid fund that you had launched. So another, again, I'm taking questions from investors. PPFAS has mentioned their conservative hybrid fund as a one-stop debt fund option for long-term debt fund, right? How should people plan to use this fund as they near the goal? So do you have any strategies that investors should use, staggered approach or STP or SWP or whatever?
So as you reach towards your goal, one option for you to withdraw money is SWP. So after 3 years, if you do it taxation wise also, it's more efficient. And we would recommend, say, 0.5% per month kind of a SWP is something which any investor should be looking for. So I think that should be good enough to take care of your monthly needs, and based on that, you need to have a sufficient corpus in the fund.
You also mentioned that your fund house has limited number of funds, which is good. From an investor's point of view, he can pick and choose. Now you have a tax saver fund, and it's March. Most of youngsters are now looking at which fund to invest in. So briefly tell us about your tax saver fund and how is it different from others.
Sure. So the tax saver fund, if you see the portfolio of both Flexicap as well as the tax saver fund, most of these stocks are same. Weightages may differ here and there, mainly because we are not allowed to invest in foreign securities in the tax saver fund by regulation, not by choice. Other restriction that we have is that we cannot use derivatives in the tax saver category. So any cash to futures arbitrage or covered call options or anything, we cannot do that on the tax saver side. But on the other side, if you look at the portfolio of the tax saver fund, we have tried to substitute the foreign holdings that we have with the Indian substitute. So for Amazon's Alphabets of the world, you have TCS and Wipro, which have been added to the tax saver fund. Instead of Suzuki, we have Maruti Suzuki. Otherwise, more or less, the portfolio remains the same. One or two illiquid names may be there because of the size of the fund also. So tax saver fund is hardly 500 crores. So that helps us in investing in some of these illiquid small and mid cap names. So overall, we now are looking to position this product as an Indian centric fund rather than a tax saver fund. So tax saving benefits is something which comes additionally with it, but primarily it's an India centric fund. And since we recommend investors to invest in Indian equities or equity funds for 5 years plus, 3 years locking should not really hurt them. So we can actually position this as an India centric fund rather than launching a new fund just for the sake of it.
Excellent. So now coming back to you briefly, Raj, tell us about sort of the mental models that you follow while analyzing a company or a security. What are the checklists you have that probably can help an investor at least do a primary filtering?
Sure. So there are 3 or 4 main points that we try and cover during our equity research process or analyzing a company. First and foremost is the promoter quality. So given the conservative nature that we have of our philosophy as well as the fund, we feel that promoter quality is paramount, and we do not want to compromise even a little bit on the promoter quality side. So we may pay up on the valuation if the promoter is good, but we don't want to compromise on the promoter side. So that first and foremost is that if that is good, then only we go to the next step. If that isn't good, then we don't go further. So after that, we look at the company or in the industry, how big is the market size, how big the company can become, whether it can take market share from others, whether the market size itself is growing or not. If the market itself is growing plus the company's market share is growing, very good. So both the things are working on your favor. Even if one of it is working but the valuations are really good, then also good. But if both are working, that's like a ideal kind of a scenario for us, where the growth run rate ahead would be really good for the company. So second would be that. Third would be on the balance sheet side. So more than the P&L statement, we study the balance sheet. So we like to have companies with very low debt or borrowings. We like companies which earn return on capital, which is sustainably over a cycle more than say 13, 14, 15%. So those are the basic, I would say, quantitative criteria that we have in terms of the financials. There are many other checklist points that we have, but these would be the primary ones. Other than that, last comes the valuation. So valuation is something which we look at last. We do not have any DCF models as such, but we try and see what the company would be in the next 3 to 5 years. So what growth the company would be able to achieve, and based on that, we come out with a valuation.
Interesting choices. You mentioned management quality as one of the first criteria for filtering, right? From an investor's perspective, or from a retail investor's perspective, what should be some of the red flags that he should be looking for, just to from his point of view, right? What are some of the red flags where immediately you should not consider investing? So what are some of the red flags that you would recommend when it comes to analyzing the management quality?
Sure. So for a retail investors, it may be a little difficult to analyze this because a lot of the data is not in the public domain. A lot of it is when you speak to a lot of people around the promoters. So if you speak to the vendors, the distributors, the customers, sometimes deal directly with the promoters. So you get a lot of data. Apart from that, on the annual reports and financial data, what you can do is you can look at the historical capital allocation policy of the company, whether they have done any capital misallocations in the past. If they have done that, then definitely that's a red flag, and you should be very careful that he or she may do that in the future as well. Secondly, you can also look at the earning transcripts of the company and see what the management is telling. Try to match that with what is happening in the company, whether what the management has told is actually happening with the company or not. That is also something which you can see. And on the guidance front, if the management doesn't give guidance, very good. If the management gives guidance, then you should check whether the management is conservative or aggressive in terms of the guidance that it gives, and whether it is able to actually meet the guidance or not in the next year. So all these are points which you can easily get from the public sources. Apart from that, you can obviously do a lot of scuttlebutt, talking to a lot of people, and get information about the promoters.
Nice pointers. And for those listeners who probably don't know, shameless plug, you can go to alphastreet.com/India and read all earnings transcripts available for free. So that's one source that Raj mentioned. Coming back to Raj, so I asked this to all my guests. You as a person pre-COVID and post-COVID, what have been some of the biggest learnings that you have?
Sure. So pre-COVID, post-COVID, nothing much has changed. A couple of changes. So I have tried and started focusing more on my health now. Given that I had a lot of time on my hand sitting at home, because before COVID I used to travel for 2-3 hours a day. So saving 2-3 hours a day, and even half of it, if you can focus on your health, that would be really good. So that is something which I have started focusing on. Apart from that, saving yourself from some screen time is also something which I'm looking forward to, because during the COVID or lockdown, we are all glued to our screens, be it mobiles, laptops, iPads, and we are all on Zoom meetings throughout the day. So post-COVID, I hope we are post-COVID right now, and we'll start physical meetings, because physical meetings is something which I missed terribly during the lockdowns. Meeting people and discussing something is completely different from a Zoom meeting and meeting them online. So that is something which I look forward to.
Interesting that you mentioned that we all hope it's post-COVID. So
Yeah.
probably I preempted the question. We are still in the midst of COVID. So yeah, it's still pre-COVID. So Raj, I know you like to read a lot. So as usual, any book recommendations? I always ask my guests, can you give us top 3 books, your favorite books or top of the mind books for our listeners?
Sure. So I'm a big fan of Peter Lynch. So the 2 books written by him, Beating the Street and One Upon Wall Street, is these 2 are the books which any new investor, retail investor, existing investor, experienced investor can read. I reread them a lot. So these two are the books which I would strongly recommend. And then obviously the Warren Buffett, Charlie Munger books are something which everybody reads. So yeah, these would be the recommendations that I would.
Nice. Thanks for those recommendations, Raj. Now, PPFS is a small and unique core team, right? You all have been career veterans there. I'm sure my listeners are interested in knowing the work culture there. How close a team you are. Some insights that we can get that is not already available. Probably I can put it as an exclusive. Tell us more about your team.
Sure. So just about 2 years back, we were a staff of about 50 people. Right now, we are a staff of about 150 people. So we have grown quite a lot in terms of staff strength in the last couple of years. But the culture has remained quite the same. So when I joined in 2012, we were all uh, provided learning resources and told to learn, to read, to spend some time of the day on reading so that you can improve yourself. On our academics also, we have been told that if you want to do any course and if you actually pass that course, the company will reimburse the fees. So that is something where we encourage the employees to take on the academic courses, improve their own knowledge base, and hence in turn benefit the company. So that is something which we look forward to. Apart from that, the structure over here is not hierarchical. So what happens in most of the firms is that you have to go through many layers before your word actually reaches the CEO, CIO, or the top management. So here it's a very flat structure, and if your work is good, you may be handed some responsibility very soon, and you may grow up the rank. So taking my example forward, so I started off as an intern to analyst to a fund manager now. So and again managing 300 crores to 25,000 crores now. So yeah, that is something which we look forward to. And going forward, as our organization grows, we hope that we'll be able to retain our culture despite the growing staff strength that we have.
Excellent. Great to hear that. Now, the $1,000,000 question, that most requested question that I got, is when is PPFS launching a new fund, or are you planning to come out with a index fund offering? Because that looks like the flavor of the season. So, when are you planning a new fund offering?
Sure. So answering your second question first, never. So we are never launching an index fund. Index fund is something which is a scale game. We don't have the scale at the expense ratio at which some of these index funds and the ETFs run. We don't think that we would be able to provide something different. So our philosophy has always been to launch a scheme only when we ourselves would be interested in investing in them, and something different which we can do for the investors. So in index funds or ETFs, we cannot do that. It's replicating the index. So there's nothing that we can do. On the new fund offering, at least in the near future, I don't see any new fund offering from our side. Post the inflow stopping in the Flexicap Fund, we had received requests to launch only an India centric fund, and that's when we changed our stance on the tax saver fund, where we thought that we have a credible 3-year track record of the tax saver fund, which is an India centric fund. The only constraint that most of the investors have is that it has a lock-in period. But since most of the investor base that we have is very familiar with the philosophy that we have, and we want investors to stay in for the longer term of 5 years plus, at least 3 years plus. So the lock-in period is something which shouldn't matter to us. So tax saver fund is something which you can call it an India centric fund, and you can call it an old fund offering instead of a new fund offering.
Old fund offering. That's interesting to hear. Last question. Talking about the geopolitics, right? There are a lot of new investors that came in the last 2 to 3 years. And this probably, looking at the kind of chatter that I see on our platform, this probably is the first time they're seeing most of their portfolio in red, and they haven't seen a cycle, right? What advice do you have for them? They are worried about, okay, is this going to end up in a third world war? Is my investment going to go absolute zero? Did I do a mistake? My parents or my uncles told me never to invest in markets. Now I did it. So to kind of give them that reassurance, what is your outlook on the geopolitical issues that you're seeing right now, and sort of crystal ball glazing, where do you see this headed?
Sure. So, keeping aside my views on the geopolitical issues, first I would like to tell the investors that those who have come in the last couple of years haven't seen a meaningful correction as such. So, a 10 to 15 or 20% correction is something which happens very regularly in equity markets, and you should be used to it. If you cannot take a 20% hit on your portfolio, then you are not meant for the equity markets, because equity markets are volatile and the returns go up and down. It's not a straight line. So that is something you should have. Secondly, all the investors should have a investment allocation in place where they put certain money in equity and certain money in debt. Whatever funds that the investor requires in the next couple of years should be in debt funds and not in equity funds. Equity funds are meant for longer term goals and goals which can be flexible in terms of timelines. So that is something which I would recommend. On the geopolitical issues, I don't have a strong view as such. We'll see what happens. But more or less, as long as your portfolio companies are not exposed to those countries or are not exposed to commodities mainly, or even if you have exposure to companies which are dependent on those commodities, if they have pricing power and if they are able to increase the prices based on the commodity price increases, you are good enough. So over a longer period of time, these cycles play out, and you should be good.
Great. So it was wonderful catching up with you, Raj. I look forward to more interactions in the future, and wishing you all the best.
Sure. Nice to meet you too, and thanks for having me.
Thank you.